JPMorgan continues to battle Uncle Sam. Bank executives are getting jiggy with TARP money. And Dr. Evil, well, he's impressed with bank payouts. You're in the right place, folks, because this is where the money is. Thanks for joining us, folks. I'm Matt Copenheffer. Right next to me, as always, David Hansen. We've got a great show for you today. We're going to be looking at housing prices and how they're impacted by inventory in the housing market. We're also going to be playing a little fool in the blank. But as always, we'll start with the headlines. And David, we've got a big one to kick it off here. Big in terms of $6 billion big. Over at Bloomberg, the headline reads, FHFA said to seek $6 billion minimum in JPMorgan talks. This refers to paying out over more crisis era run-ins with Fannie Mae and Freddie Mac. Is this going to sink JPMorgan? Is this finally the last straw that is going to sink JPMorgan?
It's not going to sink JPMorgan.
They're trying very hard.
They're trying to. This is nothing new with Fannie Mae and Freddie Mac. We saw Bank of America settle a similar lawsuit. I think it was last year. I think their tab was over $8 billion, so a little bit worse for Bank of America than what's being anticipated for JPMorgan. But again, this isn't anything new. They've reserved against these legal costs. Maybe it goes over that. But again, it's not going to be enough to really hurt shareholder equity in the long run. I know I sound like a perma bull here on JPMorgan, but again, these are headlines. They're nice headlines, and it's an interesting legal case. But to the long-term 5-year, 10-year investment thesis to JPMorgan, this isn't material. It's
really an interesting legal case. All right, so you're saying they reserved against it, and $6 billion wouldn't really hurt shareholder equity that bad. I think you're wrong because... Not really sure, but I know you're wrong. Look, the only thing I can come up with right now is that if you are a day trader in JPMorgan stock, or if you're I don't know, what do they call them, swing traders, if you're a swing trader looking at JPMorgan stock, this could be something to worry about, because if they have to pay out the full $6 billion, that could hit the stock short term. And in fact, over the past few months or so, we've seen the stock take a short term hit. JPMorgan's been in the headlines nonstop with all of these legal headaches, and it's impacted the stock. It's trailing the S&P, it's trailing the KBW Bank Index, and it's trailing its big bank peers.
Right.
And I think this has everything to do with its name being in the headlines. But longer term,
they just reported record profits there in the second quarter. So.
I guess I've got to agree with you there.
All right, moving on to our second one. We're going over to DealBook. You're gonna like this one. It says, bank executive admits to using bailout money to buy a condo. What? What is going on here?
Look, the funny thing is that when we look back at the crisis era and all of the shenanigans that went on and all of the things that happened with TARP money, with the bailout and everything, everybody wants to look at the big banks, and everybody said, oh, you know, the small banks, they're just like
Mom and Pop.
Jimmy Stewart, everything was right. Nobody was doing anything wrong there. But you got to give them credit, because when they went for it, they really went for it. So here's a little bit from that New York Times DealBook article. In November 2008, during the depths of the financial crisis, Darrell Lane Woods, a bank executive in Missouri, applied to the United States Treasury for bailout money. His bank received $1 million. Just days later, Mr. Wood used $381,000 of that money to buy a waterfront condominium in Fort Myers, Florida. Gotta give him credit. He went for it. The big bank executives and the people that are being accused of various things, it's very convoluted. If they were doing something illegal, they were treading the line. Here, he just took the money. Bought a waterfront condo. I say good for him. If you're going to do something illegal, be big and bold about it. David, if you were going to use TARP money to buy a waterfront condo, where are you buying it?
I wouldn't stay within the U.S., considering that someone's probably going to notice if I go buy a condo in Florida. I'm venturing over to, I don't know, into the Caribbean somewhere, Cayman Islands. They're usually pretty friendly to businesses trying to...
Remember, we're talking about $381,000 here. I don't think...
a nice little hammock or something.
Little hammock.
But I think the point, I think you're right on target there with the point in terms of people look at the regional banks and you see them in the way they're trading. A lot of them are trading at a higher multiple than the bigger banks. People can say, oh, the regional banks, they're a little bit safer. I can understand the business a little bit more. That's not necessarily true all the time, especially during a crisis. We've seen a lot of regional banks. For every regional bank that's performed very well, there were a lot of regional banks that either failed, that are still cleaning up messes on their balance sheet and still reporting losses because they're more concentrated in what they do. They don't have the diversification of a JPMorgan or of a Bank of America. So I think it just goes to show you that you can't paint all the regional banks. And this is a very, very small one. So I'm not saying this is the same as
this is a
very, very small community bank there. But it's just important to note that not all these banks, even though they're small, it doesn't make them saints.
Well, here's a prediction for you. Maybe not for this year, and it's not a particularly hard prediction to make because we've already seen a little bit of this. But in terms of the government and regulators going after banks for crisis-era wrongdoing, I predict that we're going to see a lot more go against the smaller banks as time goes forward. It's going to be a little bit difficult because we are hitting statute of limitations limits, but in terms of prioritizing who they're going to go after first, obviously go after the bigger banks. There's a bigger target there. There's a bigger pocketbook to go after. But I think we're going to see more of these headlines related to smaller banks.
Right.
Finishing off, number 3 headline, over at the Washington Post wonk blog, Ezra Klein, another day, another sign that Larry Summers will get the Fed job.
You're happy, right?
Here's what he writes. The latest smoke signal went to CNBC's John Harwood, who reports that a source from Team Obama told CNBC that Larry Summers will likely be named chairman of the Federal Reserve in a few weeks, though he's still being vetted. David, Larry Summers is your boy.
I don't have a problem with it. I know that you were hoping for Janet Yellen over there.
It's not hope. It's not hope.
Okay, you won it. Would I be thrilled with Summers? Would I be thrilled with Yellen? Either way, I'm going to be kind of, all right, let's see what they do. It seems to be most people have your opinion with Summers coming to the job. Most people are kind of like, why are we picking him? I don't know if he's the best man for the job. So my hope is that he gets nominated or confirmed, and the market freaks out and sells off for a dumb reason, in my opinion, if Larry Summers gets confirmed. So if he gets confirmed or nominated and the market drops 2% or some other good businesses go on sale, I'd be interested then.
I would have trouble getting excited about Larry Summers getting the job. I think he's a very smart guy. I think he would be capable of doing the job. But I think in Bernanke we saw a consensus builder in that position. And I think Janet Yellen could carry on that tradition, continue to be a consensus builder. I have to admit I also like that Janet Yellen is a little bit more of a dove on inflation, so I feel that she would continue Bernanke's easier monetary policies, which I think the economy still needs, even if just for a short period of time. Summers may do the same thing, but I'm more convinced that Yellen would carry that on. I just think Yellen would be more of a peacemaker in that position, whereas I could see Summers creating more turmoil, which is exactly what we don't need in the Fed chairman position. I think Larry Summers can do great things in many different areas of economics and policy. I just don't. I have trouble getting excited about him in this particular position.
We'll see in the coming weeks, I guess.
Moving on to the housing market, the always important housing market. You and I, we've been talking a lot about housing prices. We've been talking a lot about housing inventory. And in particular, we've been talking about how the two play into each other. And we've seen housing prices go up, up, and up. Just the other day, the Case-Shiller Home Price Index showed housing prices going up another 12%, which is either scary or very exciting, depending on what perspective you take. And one of the explanations that we come to is that inventory is going down. So one of the things that I did here was I put together a chart, and I looked at housing vacancies based on census data. And Heather, you can throw up the chart here now. So this is housing vacancies as a percentage of housing units as tracked by the census. And then it's the real home price index as tracked by Robert Shiller on his Irrational Exuberance webpage. And as you can see, not surprisingly, when home prices go up, inventory tends to go up. It spurs buying, or spurs building. But over time, we've seen the percentage of vacant homes as a percentage of overall housing units go up, continuously go up. So if we look over the past couple of years, yes, inventory or these vacancies have come down as an overall percentage, so relatively speaking, come down. But it's not like it's
rock bottom.
Exactly, compared to history. So it makes me question a little bit this idea that we have very low levels of inventory or houses available. And this would probably differ a little bit from true housing inventory numbers, because this includes things like houses that are held off the market. And that'll change things a little bit, or houses that are available for rent but not rented, and that changes. But still, these are houses that nobody is living in. So when I look ahead, if you were to think from the perspective of inventory is very, very low and we're going to need more inventory, that's a bullish case for home builders.
Naturally.
Right? Naturally. But you can rethink that a little bit if you think from the perspective of, okay, maybe there is more hidden inventory than otherwise. Now, there may be some dynamics going on that say that a higher level of overall vacancies makes sense going forward, and we're going to just build from there.
Right.
But at the same time, I think it tempers a little bit the bullish case for home builders. So what I did is I put together a table, and Heather, you can throw up this table now. This is a table of some of the major home builders. It looks at the peak, sorry, I forgot to put labels on here actually. The first number is the peak housing home deliveries, and then the second number is the peak average housing price. And then the third is just the two multiplied together. So that's for peak. For most of them, it was 2006. For Toll Brothers, it was 2005. And then we're looking at 2012. Now that multiplied number, it's very close to a revenue number, which makes sense. It's the deliveries multiplied by the average housing price. And then finally, over on the furthest right-hand column, I looked at the percentage of that multiplied out quasi-revenue number. The percentage today as a percent of what they were doing at the peak. And as you can see, it varies pretty widely. So KB Home at the very bottom, doing about 17% of what it did at its peak in 2006. And then we look at NVR. So we've got Hovnanian and Lennar kind of in there, in right about the same in the 24% range. Toll Brothers a little better in the 33% range. NVR at 52%. So when I think about home builders and home builder stocks going forward, thinking about inventory, thinking about what needs to be built, I think investors really need to dive into the specific home builders. Where are they building? Who are they building for? Is it a growing market? What's their strategy? When I look at these numbers, and I'm not too familiar with NVR, but when I look at that 50, 51, 52% of today as opposed to the peak, it suggests to me that they're doing something right. Either they're doing something right today in terms of being able to sell more homes today, or they were doing something right back then in that they didn't get carried away and overexpand their inventory, overexpand their operations during the peak period. So the strategy there, I think it would be interesting for investors to dive in and check out that strategy. What has allowed them to be steadier peak to trough than the other home builders? Similarly with somebody like Toll Brothers focuses on the upper end of the market, and that's maybe held up a little bit more, and they sell fewer homes, they have fewer deliveries. So when we think about if there's not necessarily a ton of homes that needs to be built, if you can build fewer homes, sell them for higher prices, that potentially works out well for you too.
Right.
So I think looking forward, home builder stocks, it's, again, we tend to think about these, or I hear a lot of people talk about these as a group, the home builder stocks. But they're individual companies, they're operated very differently, they operate in different geographical markets, they have different strategies, they're selling to different customers. So for investors that are thinking about buying any of these, I think it's important to understand them individually as opposed to just saying, oh, I'm making a bet on home builders.
Absolutely, and it kind of points out to me when we think about just the housing market in general and what drives prices. You mentioned a lot of people point to the number, low inventory, low supply, high demand, that's going to push prices up. When you step back and look at the housing market, it's not just a one factor type of market. There's a lot of things that can influence this, whether it be interest rates, which we've seen move up. The latest Mortgage Bankers Association numbers were 4.8% on the 30-year, its highest level in 2.5 years. So that's another factor that's going to influence demand and also how much these home builders build. And then you also have the speculation part of the equation that's very hard to measure. During the crisis, even though speculators weren't the vast majority of the market, even if they just make up a small portion of a market in a given city or a given area, that can really influence what home prices do in that area.
So whereas your barber was giving you stock tips during the 2000 internet stock bubble, he was flipping homes during the 2006, 2007
And it's
period.
not like speculators are gone either. It's just a little bit of a different speculation now. We've seen Blackstone come in and buy up all these homes. It's essentially a speculation.
If you ask me as a Blackstone shareholder, that's not a speculation. That's a savvy investment, brother.
Maybe I should change the way we define speculation there. Speculation in terms of the person buying it is not going to be the person living there. They're buying it as an investment. They're an out-of-town buyer, if we can use that term, in that market. So all of these forces can impact the stock, or not the stock market, the housing market. So I think just the fact that you point out to the inventory, it's not kind of a, oh, this is guaranteed a good news for the housing market for home builders. There's much more to the story. All right, moving on to our game for the day. We're bringing back Fool in the Blank. This is the game where I'm going to read a sentence with a blank in there and fill in with your answer. So the first one we have here is blank is a stock I could buy today and sleep well if the market shut down for 5 years. What are you buying?
I could fill this in any number of ways. I think that the regular viewers of the show would probably expect me to say Berkshire Hathaway, and that is true. That is absolutely true. I could buy Berkshire Hathaway today and sleep fine for the next 5 years. But just to put a very fine point on it, I'm going to say JPMorgan. I could buy JPMorgan, and I do own JPMorgan right now. If the stock market closed down right now, or let's say this, if I got a telegram saying the stock market is going to close down today, if we went back to 1950 and I got a telegram and it said the stock market is going to close tomorrow and be closed for 5 years, and I looked at my portfolio, JPMorgan would not be a stock that I would sell. What's yours?
I'm going to go with Visa. Yesterday we were talking about the mortgage REITs and how this is an industry that if one of them went away, not that much would change. As a group, they may provide some liquidity to a market, but as a whole, as individual companies, they're not that big of a deal. When I look at Visa, if Visa went away, I don't know what would happen. I mean, credit cards would just, I don't know what, it would just be crazy.
You have to use Discover, oh my gosh.
Discover. They're the biggest credit card network out there facilitating all these payments. I could buy Visa today and be very comfortable.
Do you own Visa?
I do not own Visa.
Buy it.
Okay, we'll see. All right, moving on to the next one about Goldman Sachs. Goldman Sachs has managed to blank legal risk.
I'm going to get a little creative here, and I will say cha-cha past. Cha-cha. It's doing the cha-cha right past the legal risks. When we look at the bigger banks, the Bank of America, certainly JPMorgan, particularly right now, Citigroup, even Wells Fargo, Goldman Sachs has had a few high-profile, interesting Us Weekly type cases like the Fab Torre case, but in general, far less exposure than the other bigger banks. So I'm saying it's cha-chaing past those legal risks. What do you say?
I'm going with powered through. Legal risks are there. They've had to deal with some of this stuff, whether it's the Abacus trade, Fab Torre, but the business has powered through. It's continued to do well from an investment banking side, from a trading side. Firm's in a very strong position from a capital perspective, very well positioned to go forward the next 5-10 years in terms of for their shareholders and with dividends, buybacks, and the business is doing well, so they're powering through. Next one we got is Warren Buffett has a blank diet. Thoughts?
I'm going with delicious.
Delish?
I am going with delicious. I happen to be a vegetarian myself, but cherry Coke, hamburgers, steaks at Gorat's, and sitting there watching him and Charlie Munger during the Berkshire Hathaway annual meeting, just killing boxes of See's candy. He has a delicious diet.
I'm going with it must be working diet. I don't know. I mean, he's, what, 83 years old?
It's brain food.
83 years old, still coming into work. If I'm 83 years old, doing the things that he does, making billion-dollar deals, it must be working.
I think they actually said at this year's annual meeting that See's candy is brain food.
There you
and
go.
For any shoppers out there, go ahead, go buy some See's candy.
Last one we got here is if I had one book in my investing library, it would be blank. What do you got?
The first thought that comes to my mind is Intelligent Investor, and I think that's the right answer for a value investor and maybe for a foolish investor. I would actually go with, there's a book that compiles Warren Buffett's letters to Berkshire Hathaway shareholders. I think once you read Intelligent Investor, at least once I read it a couple times, kind of got it. And I don't refer back to it a whole lot. But Warren Buffett's letters to shareholders, I refer back to those all the time. So I think that would be great to have in my one book permanent collection.
I'm going with Margin of Safety by Seth Klarman. I have not read the book. So full disclosure, I have not read the book.
Because you don't have the, what is it, like $10,000 to get
That's the thing. If I could have one, I get it. Then I could potentially sell it and get more and really bolster my, that's a value.
This isn't about price. This is about space. You have a bookshelf that only holds one book.
That wasn't specified in the fill in the blank. So I'd get a Margin of Safety. That's a value play.
I'm not giving you a copy of it. I'm not giving you a copy of it. So you still have to buy it.
Oh, we have to. Well, you didn't say that. Anyway, going with Margin of Safety. I haven't read it, but it's on the list of finding it some way out there to get my hands on it and read through that. So I'm going with Margin of Safety.
All right, let's finish off as always in the Twitters. David, take us out.
All right, the first one we got. It's actually 3 tweets in one. And I was going through the feed today, and I saw all 3 of these post back to back to back from Discover, Ally Bank, and Capital One, and it caught my eye because they're all about school and student loans. So Discover was about student loans, Ally Bank talking about back to school sentiment, Capital One has some winning tickets to a Maryland game. But it got me thinking kind of just about the student loan industry, obviously hotly debated amongst students, amongst the financial world. And it was interesting from Discover. Discover's the one company that's kind of charging into this space. A lot of banks have scaled back their student lending without that government guarantee anymore with that new regulation in place. So it's interesting that Discover is kind of promoting the student loan business. They're still charging ahead. Year over year, they've actually seen charge-offs go up and delinquencies go up on student loans, which is kind of interesting, even though they're still expanding the portfolio. So it's just something to watch. Discover's that one company that's really charging in with a lot of scaling back. So interesting one to watch there.
I think it's one interesting thing to think about too, and this is maybe a message to the banks, is just in terms of these student loans, and I think particularly about a company like Discover, this can be a great opportunity to make a good impact on potential lifetime customers. Mm-hmm. And I don't know that the banks think about it this way, because when I was in school, I didn't have private student loans. Uncle Sam was my major lender, but for the folks I knew who did have private student loans, I didn't hear anything about the bank that they would say, oh, this is great, I want to be with this bank for forever. But this is a great time to have a good customer experience with a bank on a major transaction, big student loans, and become a customer for the rest of your life.
So if you're a shareholder of Discover, you're not worried that they're charging into the space that a lot of people see as the next kind of bubble out there. Not bubble, but something that could go wrong in terms of lending. You're not worried if you're a Discover shareholder.
No, I think that it's... I think that maybe there could be an issue with the cost of education, and maybe something has to happen with that. But the idea that a education that's going to last you the rest of your life, that's actually an investment. I mean, if you look at the numbers, the employment numbers, college versus non-college, there's some fuzziness around that. But I do believe it's an investment, and so helping people finance that investment. I don't see anything wrong with that. And if you can do it right, and you can create a good experience for that customer, you can keep them coming back for the rest of their life. And I think that could be a good thing.
I would agree. And you look at Discover too, from their credit card loans perspective, they've done a fairly good job in terms of giving loans to people, or in terms of pricing those loans right, and not being overwhelmed by making bad credit card loans. So I think you can say with some sort of confidence that they're going to make student loans that are good loans in the long run. So I think you have to give Discover the benefit of the doubt here.
Moving on to the next tweet, we've got Laura Marcinik. It's at Laura Marcinik. The tweet is, Dr. Evil would be impressed with this legal cost tab.
$1 million.
He's very impressed.
He is very impressed. And the costs do keep adding up, but we're still bullish on the banks nonetheless. Are we crazy?
The number that they point out in the headline there is $100 billion. So even more than Dr. Evil's $1 million. Imagine
that.
$100 billion, and the banks that she mentioned in the tweet there, I think it was Bank of America, Citigroup, JPMorgan, the big ones, Goldman Sachs, Morgan Stanley. So $100 billion, that's the cost of what they've had to shell out so far. I went back and looked at the combined profits of these companies for the last 3 years. So profits, even taking into account the legal costs, the legal reserves that they've had to take out, combined profits for these 5 companies over the last 3 years, $166 billion. And a lot of that is driven by JPMorgan and Wells Fargo. They're the ones that are really carrying the pack right now. But it just goes to show you that, yes, the legal costs are a lot, But these are some pretty big profit engines over the long run once we get back out of the whole crisis era. Once they stop charging off so much, there's a lot of them are still charging off a lot of loans.
But it's always going to be like this, David. They're always going to be
There will always be some charge-offs. But when you think about a bank like Bank of America, not very profitable in terms of that bottom line quite yet because of all these legal costs. Once they get back to a normalized level, they could be raking in $20 billion in annual profit, like the Wells Fargo and JPMorgan.
Or $1 million.
I don't know if Brian Moynihan would be happy at that, but it just goes to show you the profit engines behind these. So yes, the legal tabs is a lot, but they're still making a lot of money. Oh, the last one we got. One more.
One more
from the FT.
We don't want to shortchange our viewers, David.
Almost forgot it. All right, last one we got from the Financial Times at FT. Most read right now on our site. Rupee suffers worst sell-off since 1995. Matt, why is this the most read article on their site right now? Who's caring about the rupee right now?
Well, one thing I will say in defense is that FT's readership tends to be more global and maybe European, so not as U.S. focused. But yes, the tongue-in-cheek tone that you were taking, I think, is warranted. There's a lot going on any given day. You can always find some big event going on in any given day, but does that impact what you're investing in? So if I'm investing in a Wells Fargo or a JPMorgan or Berkshire Hathaway, any individual, is this rupee sell-off really something that I should be concerned with? But when it gets into the headlines and when people start flocking to it, when it becomes the most read article, then I think people can start to become concerned with it, whether it matters or not.
Mm-hmm. I agree. It makes sense on a certain level, but again, like you said, you can find something every day and sensationalize it and be like, this is the thing that's going to start the whole sell-off. This is the pullback that we're due for. And our colleague Morgan Housel looked back at stock market history, and the average is around every 11 months or so, we get a pullback of around 10% from highs. We haven't really had a 10% pullback in the last 11 months or so. That's the average. I'm not saying it's a set schedule. But so everyone's trying to point to that one thing and say, oh, this is the big sell-off that's coming. It's going to come eventually.
So you're saying it's coming now?
I don't know if it's because of the rupee selling off, but it just goes to show you that there's always going to be stuff going on. If those dips happen, it's just part of the stock market.
Well, you heard it here, folks. David Hanson predicting the next stock sell-off. In the meantime, hang on to your rupees. David and I will be back tomorrow. Thanks for watching.